Many people aspire to achieve financial freedom. This is the goal of the young and old. While some people have been able to bring their imagination of wealth creation to reality, a lot of people just wish but are honestly far from the reality. This video is going to reveal why a lot of people are struggling with financial freedom. Watch it carefully to find out the struggle. You do not want to miss what will be exposed about real and fake assets. It is paramount to know that just earning money and saving it consistently or piling it up regularly is not the appropriate way to create sustainable wealth. You need a proper understanding by paying attention to details. Let's use a class of students. They all are taught the same thing, but they all can never produce the same result. This is because some are distracted while others are focused. Some study what they have been taught over again until they become masters, while others dump the knowledge right there where it was taught. When it comes to sustainable wealth creation, here is the real deal. Acquiring and managing assets consistently is the right way to sustainable wealth creation. Pay attention to the words asset acquisition and asset management. They are key to successful wealth building. Before we delve into the exposition of the above terms, subscribe to this channel if you have not. To take advantage of the practical steps this channel will continue to show you as we build wealth together. Let's start by answering these questions. What does sustainable wealth mean? Sustainable wealth is the ability to maintain a particular standard of living secured financially over a long period of time. It has a secure financial base that is not easily affected by inflation negatively. It is like the foundation of a skyscraper. It aims to transfer the load of the structure from weak areas of the soil to the firmer strata. Attention is paid to the foundations of tall buildings to avoid future disasters. Practically speaking, financial security is like a guard intentionally orchestrated by the rich. The word security means to be free from anything that threatens. Measures are therefore put in place to guarantee safety. It is the same way it applies to finances. The intentionality of ensuring financial safety measures is what births the sustainability of wealth. What are assets and the concept their acquisition in wealth creation? Assets, as the name implies, generate income for their owners over time. It is this income generation characteristic that qualifies anything to be an asset. Let's make it practical. Just look around you right now. What do you have that generates income for you right now, or has the potential to generate income for you consistently? How many can you count? Grab a pen and paper to write them down. These are your assets. Look at it in another way. What can you think of that can generate income for you? You probably do not have some of income-generating things on your mind now, but you know they are sources of income. You also need to write them down. They can make the list of some of the assets you may consider acquiring. Why do we need to pen down these assets and not just keep them in our memories? Writing them down gives you the opportunity to go back to read them, digest them, tick them up as you acquire them. Have you ever written a to-do list? There is a sense of fulfillment when you tick each item as done. Same applies to this scenario. How many assets have you written down? Let's know in the comments section. Another feature of an asset is that it can hedge against inflation due to its ability to grow in the future. This is where the subject of fake assets comes in. There are times some investments start sapping your income instead of generating income for you. Any so-called asset that depletes your income has become a liability and not an asset. Let's practicalize it by using an Uber driver. This Uber driver purchased a car with the intention to generate more income. The car for a reasonable period has made this Uber driver spend money on repairs without generating income from the car. The car spends more time at the mechanics than being on the road to generate income. We do not need anyone to convince us that this is a fake asset. It is very important to acquire real assets. However, the ability to manage these assets strategically is what can bring out the valuable features of these assets. 5 types of assets that can be acquired for wealth sustainability. To ensure wealth sustainability, you should consider acquiring a combination of tangible and intangible assets that align with your financial ambitions and risk tolerance. Here are some assets that generate income for you when you acquire them. The list can go on and on. Feel free to watch more of our videos on asset topics to discover more assets. The assets mentioned here are listed and explained in no specific order of preference. 1. Stocks and equities. Investing in stocks is one of the ways to acquire assets. A lot of companies sell their shares to the public and in return distribute their profit with investors. The way stock investors make money is by earning dividends, bonuses, and capital appreciation. However, knowledge of the stock market and share performance is important. This is because as much as this is a form of asset acquisition, it can be very risky. It is important to study the viability and sustainability of companies that are publicly quoted to determine how their shares will perform over a long period of time. Understanding the company you wish to invest in is very important. Identifying a viable public company involves conducting detailed research and analysis to assess its financial health, competitive position, management team, and growth prospects. You can go over a 5-year period financial statements of these companies. Using the company's income statement, analyze the company's revenue growth and profitability. Using the company's balance sheet, which is also known as Statement of Financial Position, analyze the company's assets, liabilities, and equity to ascertain how stable the company is. You also need to analyze the company's cash flow statement, profitability metrics like return on equity, ROE, return on assets, ROA, to understand how efficiently the company manages its resources. Studying the dividend history of the company you wish to invest in is paramount. Assess the company's corporate governance and its commitment to research and development. This various analysis will help you track the growth and viability of companies. It is usually advisable to invest in shares gradually but consistently over a long period of time. Reinvest most of the earnings to harness the power of compounding and avoid speculations. It is also important to speak with your financial advisor before investing in stocks. 2. Real estate. Investing in real estate is a lasting strategy for building sustainable wealth. Properties, whether residential or commercial, can produce rental income and appreciate over time. Real estate investments provide a tangible asset that tends to be more stable compared to other investment classes. Diversifying across different types of real estate and geographic locations can mitigate risks and improve long-term sustainability. It is difficult to see wealthy people without having real estate in their investment portfolio. One of the ways people invest in real estate is by purchasing a below-market value property, improving the property, then selling it at a high value. This is called flipping. The profit from flipping is usually tangible, and this profit can be reinvested in real estate or other forms of assets. This reinvestment of profits is one major secret of wealth accumulation. The tax benefit of real estate is also another way real estate investors save money. All expenses on the property are deducted from the income generated from the property before taxes are applied. 3. Precious metals. Gold, silver, platinum, and palladium have intrinsic value. They are considered conventional hedges against economic uncertainties. While their value may fluctuate, precious metals often preserve value during times of market instability. Including a modest allocation of precious metals in an investment portfolio can act as a hedge against inflation and currency devaluation. During times of economic downturn, political instability, or currency devaluation, precious metals often retain their value or even appreciate. Gold, in particular, is recognized for its historical worth as a store of value. Investors flock to gold as a form of insurance against inflation, deflation, and geopolitical risks. These assets have a low correlation with traditional financial instruments like stocks and bonds. When stock markets experience instability or dips, precious metals may perform differently, providing a buffer to the overall portfolio. Diversifying with precious metals can improve risk-adjusted returns and ease overall portfolio risk. In addition to physical ownership, investors can gain exposure to precious metals through financial instruments such as exchange-traded funds, ETFs. Mutual funds or mining stocks, ETFs in particular, have become a prevalent way to invest in precious metals without the logistical challenges of storing and securing physical assets. These financial instruments track the price movements of the inherent metals, providing investors with a convenient way to access the precious metals market. The supply-demand dynamics of precious metals also add to their investment appeal. Gold and other precious metals have limited natural supply, and their extraction can be both costly and time-consuming. As global demand for these metals expands, driven by factors such as industrial use, jewelry, and investment demand, their scarcity can drive prices higher over the long term. It is important to note that while precious metals can act as a hedge, they do not generate income like dividends from stocks or interest from bonds. If you have enjoyed this video this far, kindly subscribe, share, and give it a thumbs up for YouTube to keep recommending it. Moving on. For business ownership. Having a business or equity stake in a promising business can be a substantial source of wealth. Successful entrepreneurship can earn substantial returns, and having ownership in a profitable business contributes a layer of diversification to one's asset portfolio. One universal form of business ownership is sole proprietorship. A single person operates the business. This is simple to set up and offers full control to the owner. However, the owner is personally liable for the business's debts and obligations, which poses a considerable risk to personal assets. Partnerships are another form of business ownership where two or more individuals share ownership and responsibilities. General partnerships involve shared management and unlimited liability, while limited partnerships provide a hierarchy of ownership, with some partners having limited liability. Partnerships often benefit from diverse skills and resources, but disagreements among partners can be a challenge. Let's also consider the concept of equity in private companies, as this video had earlier explained public equity, owning shares in public companies. Business ownership via equity in private companies is a vital concept that plays a pivotal role in the dynamics of the business world. Equity represents a share or ownership interest in a company, and in the context of private companies, it often takes various forms, providing individuals with a stake in the company's success and a potential avenue for financial returns. Shares in private companies are often held by a select group of investors, founders, employees, or other stakeholders. These shares are not traded on the public stock market like public company shares. One of the primary ways individuals acquire equity in private companies is through direct investment. Note, the valuation of private company equity is often a complex process. Unlike publicly traded companies with readily available market prices for their shares, private companies rely on various methods such as discounted cash flow analysis and comparable company analysis to determine the value of their equity. The concept of valuation is a crucial factor in negotiating investment terms. Understanding the complexities of equity ownership in private companies is essential for individuals navigating the intricate world of business and finance. Choosing the right form of business ownership requires careful consideration of the business's nature, size, and goals. Factors such as taxation, liability, management structure, and the ability to raise capital all play a crucial role in this decision. Entrepreneurs often seek professional advice to navigate the complexities of business ownership and ensure the chosen structure aligns with their long-term objectives. Beyond legal and structural considerations, successful business ownership also involves effective leadership, strategic decision-making, and adaptability. Owners must stay attuned to market trends, customer preferences, and industry changes to position their businesses for success. Building a strong team, fostering a positive company culture, and implementing sound financial management practices are vital aspects of effective business ownership. 5. Digital assets. Digital assets are a crucial component of the modern economy, representing a wide range of intangible assets that exist in digital form. These assets have become increasingly prominent with the rise of technology and the digitalization of various aspects of our lives. Here are some examples of digital assets that play a significant role in today's digital world. Cryptocurrencies, ebooks, social media accounts, digital arts like non-fungible tokens, NFTs, mobile applications and softwares, virtual real estates, data and databases, etc. The world of digital assets is diverse and ever-expanding, incorporating a wide collection of intangible assets that have become integral to the functioning of our digital society. As technology continues to advance, the importance and variety of digital assets will likely continue to evolve, shaping the future of the digital economy. As mentioned earlier in this video, keep a tab on more assets by watching Assets for Successful Wealth Creation on this channel. Remember, I asked you to note two major concepts of wealth sustainability: asset acquisition and management. Let's delve into how to manage assets. It is not enough to acquire assets. Managing the assets is vital to be successful. Asset management involves the strategic allocation, monitoring, and optimization of assets to achieve specific financial goals while minimizing risk. Whether individuals, businesses, or institutions, those who implement successful asset management strategies are better positioned to navigate economic uncertainties and capitalize on opportunities. One key aspect of successful asset management is the development of a well-defined investment strategy. This begins with a clear understanding of the investor's financial objectives, risk tolerance, and time horizon. By aligning investment decisions with these factors, you can create a tailored approach that maximizes returns while mitigating potential downsides. Risk management is an integral part of successful asset management. While some level of risk is inherent in any investment, it can be managed through diversification, hedging strategies, and careful analysis. A successful asset manager not only seeks opportunities for growth, but also implements measures to protect against potential losses. This requires a balance between risk and reward, tailored to the investor's risk appetite and financial objectives. Furthermore, technology plays a crucial role in modern asset management. Utilizing advanced software, artificial intelligence, and machine learning algorithms enhances the efficiency and effectiveness of asset management processes. These tools enable asset managers to analyze vast amounts of data, identify patterns, and make informed decisions in real time. To be successful and sustain your wealth, you need to carefully combine asset acquisition and management. Ensure you seek professional advice before you make decisions and invest, as this video does not act as professional advice for investments. Enjoy the next video.